got the highest debt ever, and then we've got the highest amount of interest payments because you're matching a relatively high rate, not a historically high rate, but a relatively high rate for the past 25 years or so. And so again, part of the reason that the Fed had to cut rates, and they will never say this, is because the
So we have a very special guest today. I'm really excited to really dig into the economy and everything going on. Dr. Nomi Prins is a geoeconomist, founder of Prinsights Global, and best-selling author of 7 books. You've been busy. She's a tireless advocate of real financial reform, including the establishment of a national infrastructure bank. The legislation for which she has been working on for 4 years is currently making its way through Congress. She's a regular guest on media outlets including CNBC, C-SPAN, BBC, CNN, MSNBC, Fox Business, Bloomberg, and now this show.
Yes.
Thank you for coming on today.
Thank you so much. It's great to meet you in person.
The timing was impeccable because this was, our booker reached out yesterday, and I just have been thinking about I need to be talking a little bit about the economy, and then you popped on the scene yesterday. So I had to put this together pretty quickly. I'm very excited about it. I want to get started with, I want to learn a little bit about your National Infrastructure Bank, though. Can you tell us a little bit about that?
Sure. So a National Infrastructure Bank is actually something that our country has had in its past history 4 times successfully. It's been a way to use current outstanding debt, of which the United States has a lot, and to repurpose it to back loans to solely infrastructure projects. We've done that, that's how we got out of the Revolutionary War debt. The Civil War debt, Lincoln created a version of the infrastructure bank, and also Hoover and then FDR created something called the RFC, which was basically repurposing debt into infrastructure projects. 4 times this has been successful in our country's history. Internationally, many countries currently have an infrastructure bank that focuses solely on their infrastructure, which is one of the reasons that our infrastructure has basically fallen behind on an international competitiveness level, and other countries, for example, like China, have been really implementing their infrastructure projects and strategies better. So what the National Infrastructure Bank would do, and there is a bill currently in Congress, it has 41 co-sponsors in Congress across the country. There's I think 6 or 7 from California, New York, Ohio, just basically across the country that have signed on to this bill. It's called H.R. 4052, which has been sponsored by Representative Danny Davis of Illinois. And there is a Senate bill, this is kind of fresh information, that is about to be introduced in the next couple of months before this Congress is out of session to also basically tie into these infrastructure needs. They would take $500 billion worth of Treasury debt, which is a fraction of debt that is already outstanding, from investors, from pension funds, from whoever wants to swap that debt into the National Infrastructure Bank in return for a 2% increase over the Treasury yield. So that's how investors help to seed the bank. And then the bank would use that $500 billion as collateral, as we do in mortgages, as we do in real estate, to make 10-to-1 leverage loans against that collateral. So it would be able to fund $5 trillion worth of infrastructure projects. That sounds like a lot of money. But when we consider that the American Society of Civil Engineers has graded American infrastructure at a C-, that 42 to 58% of bridges in this country are effectively failing or deteriorating. That's just bridges, that doesn't count roads and highways and ports and needs for airports and such. The total tab to just get us up to date on failing infrastructure that needs to be modernized or fixed comes to about that over the life of those projects. So that's an objective figure. So the idea would be that we repurpose our debt, we only purpose it for infrastructure, and that we do this on a scale that's large enough and taken out of the U.S. budget. So it would not create more debt on the U.S. budget. It would not go through arguments in Congress, of which many happen all the time, about each project, because the bank would look at the due diligence of the loans and everything else like any other bank. And it would not increase taxes because the bank would be self-financed and self-sustaining. So it's gotten a lot of interest, and particularly accelerating interest, as we recognized how deeply behind we are as a country. This is a bipartisan recognition relative to other countries that we're in effectively international competition with. So I think you can expect to hear more about this as the Senate bill comes out and as we get into the next Congress, no matter who is in the White House.
Yeah.
And what that also means is projects will be funded. So the infrastructure that helps real estate, the infrastructure that helps transportation, that helps logistics of supply chains, all of that would be what is under the purview of the bank.
I can see why you're behind it. It seems like common sense, right?
It's complete common sense. And actually, I want to mention this in other countries, and I travel quite a lot on financing, on infrastructure, on commodities, and so forth, economic analysis, all sorts of conversations. Whenever I mention that this is something we're thinking about doing in the United States, again, after we've abandoned it successfully, having been accomplished successfully 4 other times, they say, well, yeah, look what you just said. This makes perfect sense to me. What's the catch? There isn't really a catch, except for the longer we wait to sort of ring fence the needs of financing for our needs in infrastructure, the more expensive it gets.
Right.
You know, prices don't go down. Builders don't charge less.
That's for sure, especially right now. Looking at some of these costs, it's pretty amazing.
That's right.
You know, we've seen this half-point rate cut last week. It put a lot of hope in the economy. What is your thought on our current economy, where we're going, and how it's going to look going into 2025?
Sure. So some of this does, when I look at the economy, I look at real economic growth versus financial speculation. And where the two and when the two can meet, it's more sustainable and it's better. And I think we've got some issues and some problems as well as some paths for success on mirroring those two things. So the 50 basis point cut, which surprised some market participants because the expectation at first had been 25. It quickly went to 50 really the week before the cut actually happened. And there was a couple of reasons for it being a more aggressive cut for that first cut out since really March 2020, since rates were cut during the COVID pandemic. Because the Fed recognized 2 things. One, primarily that the labor market is faltering more than it might have wanted to admit a couple of months ago. We've had successive months of rising unemployment. We have the number of jobs for the people that are looking for jobs have declined to levels that we actually haven't seen since 2008, 2009. So some of the parameters around the labor market, if you break into them, are kind of showing some direness. And so that was one of the main reasons that the Fed decided that even though inflation was above still its 2% target rate, which it had said, and Chairman Powell had said months ago, as recent as months ago, and certainly a couple of years ago, they're going to be steadfast at getting to. They kind of abandoned that steadfastness about fighting inflation to pivot to, but we need to sort out the labor market and make sure it doesn't get worse. And also the economy itself, if we adjust GDP growth, which is only one measure of the economy, it's a broad measure, it's not the best measure, but it's what we use. Adjusted for inflation, our economy is kind of flatlined. And so we don't have an economy that's growing. And as a result, it's not necessarily that we're in a major recession but we're in a soft landing or whatever we define it as. The reality is if you adjust our growth by inflation, you get something close to zero. And depending on how high inflation could get for additional factors we don't even know about, it's come down. The pace of price increases has declined, but the increases are still going. Things are still more expensive. If that pops up for any reason, for a geopolitical reason, tension in the Middle East, whatever it might be, all of a sudden inflation starts to significantly outpace growth, and it looks like we are recessive in growth adjusted for inflation. So the Fed looked at all of this and said, all right, well, we're going to have to step up our rate cut cycle and also the magnitude of our rate cuts. And so that's why not only did they cut 50 basis points instead of 25, they forecast through something called the dot plot, which is how all the Fed governors anonymously sort of say what they think rates should be at and where they think they should be over time.
Plot?
The dot plot.
Okay.
It's called the dot plot.
Okay.
It's the dots are simply where anonymously each FOMC director can suggest where rates will go, and it's just kind of a scatter plot of dots based on these anonymous levels. But reading the most recent one, it says that we're potentially going to get a total of 100 basis points cut or a full percentage point cut by the end of this year. And we're not far away from that. We've already done 50 basis points.
Right.
So what that means is there's 2 more meetings left for for the Fed, for the FOMC, for now and the end of the year. And it's very possible you get 25 or 25 at each. It's even more possible that one's 50 and one's 25. So they've moved the goalposts from what had been potentially 75 basis points over the year, which they had suggested in the beginning of the year, to now we've gone through 50. They've moved them up to 100 basis points. I think if we consider that we could get more weakening in the labor market, which is the trend, or potential spikes in inflation, which because of what's going on and what's ratcheting up in the Middle East and South China and so forth, could present more inflation. It's going to be a coin toss, but I think we're going to potentially get more than 100 basis points over this year. Ooh. And what that means is anyone who's financing anything, anyone who's waited to finance anything, even with the expectation that the Fed would eventually cut rates, as they have now started to do, has that opportunity to start to put those ducks in a row.
Do you think there's a risk of bringing inflation back by cutting that much?
There is, but there's two types of inflation, and this is where the Fed's kind of abdicated its let's stick to the 2% figure or below 2% target figure already, because inflation is still above that, and yet they have already cut rates. But what the Fed hasn't done, and I think what people don't really recognize when we hear the word inflation, or a lot of them, because it has a lot of factors, there's monetary inflation, how the cheapness of money in the system can create more speculation in the system, can create more of what's called money supply swashing around the system. Banks can use it to buy stocks, to buy back their stocks, as can corporations and so forth. So there is inflation in money, in the availability and cheapness of money that happens when you cut rates. And that can mean people buy things, that can push up prices, yes, and that can create inflation in prices. However, some prices can't be impacted by that, and that is supply chain prices. That is things like oil and gas. That's things like the price of steel or the price of aluminum and building, or other things that have many more factors beyond what the Fed does, that are more global, more based on where other economic growth is going, where logistics or transportation might stop because there's a war or whatever. So just to get back to your question, will the Fed potentially create inflation by cutting rates? They might in the things that require financing. However, if we look at house prices have pretty much gone up this entire time, regardless of the fact that the Fed has tightened rates by the fastest, largest tightening span in history. So it's you have to unpack what inflation really means. So can it cause some more inflation in housing prices? Yeah, it can. Can it cause more inflation in the amount of debt that people have on their books and that the country has? Yes, it can. Is it going to impact inflation that comes from the outside, which could itself increase anyway? It doesn't really impact that.
Gotcha. I want to touch on consumer debt and our national debt. Seems like consumers are pretty strapped right now. Is that what you're seeing as well?
Yeah, absolutely. I mean, our household debt in this country, according to just even the recent reports from the New York Fed, is over 17 plus trillion. I mean, we're talking about a significant record high level in total household debt. And that includes car loans, it includes credit card debt, it includes mortgages, it includes second mortgages. But if we look at all of that debt together, the U.S. consumer, the U.S. household is at its all-time strap level. And not only that, because rates have gone up by so quickly since the Fed started raising rates in March 2022, people are paying more interest on growing debt than they have had to pay in decades. So we've got the highest debt ever, and then we've got the highest amount of interest payments because you're matching a relatively high rate, not a historically high rate, but a relatively high rate for the past 25 years or so, with a major escalation in debt. So that means that before anyone does anything to move forward, they're paying a lot more on the interest for debt. And debt's being used for so many more things now, and it's like a greater portion of utility expenses, rent, food. It used to be when people were less strapped that your credit card was used for those extras. You know, it was used for that TV or for that luxury item or for that trip or things that weren't sort of mandatory in your life, like gas in your car, turning on your electricity and eating and rent. But what was happened is more and more people are putting those necessary items on credit as well, and that creates even more of a anxiety. And then you throw into that the country is massively in debt.
And
continues. There's no path, and this is from either of the president contenders right now. No one has a path. No one's even discussing, literally having a conversation about how to reduce that debt. And either party's platform basically embeds a greater amount of debt being created over the years to come. So we just, as a country, reached $1 trillion of interest rate payments on that total of $35 trillion of debt. Again, just like for the consumer, because the Fed's raised rates and the U.S. has borrowed more, so therefore it's paying more interest on that bigger amount that it's borrowing at higher rates. That means before the U.S. government turns its lights on, before it pays for anything, it has to fork out $1 trillion just to make good on its interest payments to basically the countries and institutions that have loaned the U.S. government money through their debt. So it's a crazy, crazy cycle that we're in right now. And so again, part of the reason that the Fed had to cut rates, and they will never say this, is because the expense of that debt was getting just so onerous for the country and cumbersome for consumers. But I think somewhere in there, there's a. It's not quite sure where the Fed really leans.
Right. How do we get this consumer out of this debt? I mean, what path do we need to go to make that happen?
That's a really interesting question, and I think what consumers should be doing is taking advantage of any of the lower interest rate steps that happen along the way to. I'm not in favor of like debt consolidation services because I think those are all ripoffs.
Yeah.
But to the extent there's a potential personal loan path or a home equity path or something where there's a lower cost to that debt, which is used immediately to pay off the higher cost of debt, not to incur more debt, but to basically be swapped into paying off the higher debt. I think that all consumers should be aware of that, and also aware of the costs, so that I'm not suggesting them take more debt, which is partially cheaper, but to literally use the cheaper debt to pay off some of the more expensive debt, but not to fall for those consolidation services. I think everyone should be able to look into that themselves and do their own homework on that. I think that's very important because otherwise they're actually going to be paying more money to do what should be alleviating their debt burden.
Yeah. That's something. Bankruptcy filings. In August, we hit the highest level since 2020, and the second highest since 2009 and 2010. Yeah. Is this, obviously this is an issue here in the U.S., is this an issue in any other countries right now?
It's a more acute issue in the U.S., and part of the reason for that is we are more dependent on credit than other countries, or than people in other countries, and this has just been the historic trend that has developed in terms of the ease by which people can access credit, the amount of credit card offers and other types of credit offers that sort of bombard the consumer at times where it feels necessary to take that money and so forth. So the fact that we have this massive household debt compared to our population size and compared to other countries, we lead in that. So if we look at personal bankruptcies and smaller corporate bankruptcies that are basically amassed a significant amount of debt at these, again, higher rate levels, we are actually worse compared to other countries on an individual basis. And a lot of those numbers, and the fact that we're at 2010 numbers, this is significant. Because back then, when those bankruptcies were happening, a lot of them were happening because there was an acute lack of confidence in all financial systems, so banks stopped lending as much because they were trying to figure out how to survive. Right? I mean, some of the bailout money came from the government. Other bailout avenues were made possible by the Federal Reserve. The bigger banks survived. Some of them gobbled up the second biggest bank. Some of them gobbled up the medium-sized banks. But in general, they were able to sort of get through it with government and Federal Reserve help, which individuals weren't. And that was part of the reason why when individuals or small businesses couldn't get loans, bankruptcies were so high back in 2019 at the time. Here, it's a little bit worse because rates aren't at 0%, which they were then, and debts are higher per average consumer and per average household and per average small business than they were then. So what we're seeing right now with those bankruptcies coming in, unfortunately, because it's going to take a while for the Fed to reduce rates and for people or companies to refinance to the extent they can take advantage of becoming more whole on their expenses and their interest expenses, we're going to see, unfortunately, that figure rise. And so, again, anything that people can do or small businesses can do to obviously cutting expenses and things that are more reasonably assumed that people should be doing or companies should be doing, but also in these refinancings as soon as possible, as cheaply as possible, can at least help to mitigate that, because again, I do think the Fed's going to have to at least make it on 100 basis points or accelerate beyond that. I do think we're in for a spate of accommodative policy.
You brought up bank mergers and acquisitions. That was something a year, 2 years ago we were seeing a good amount of. Do you think that's something that's going to continue?
I think so. We've seen a bit of a gap, and right, last March we did see some major banks fail, and then some of those get taken over by bigger banks like JP Morgan Chase, which took over First Republic, and there's been some other less high profile, somewhat non-failures, but mergers in that space. But for the most part, we've had a little bit of a gap at the moment in terms of new big mergers. But in general, what happens is when banks, especially with the regional banks and their commercial real estate portfolios, if they start to continue reducing the valuations of their collateral, which will happen if the collateral itself, if the properties devalue further, and also if people take out their money, depositors, right? Because with rates being cut, there's less of a reason to keep money in savings accounts and bank accounts, not just because consumers are strapped because they need to pay their credit cards, but also because they're just not making as much to look for other avenues. So those two things together are going to put more pressure on particularly some of the regional banks, particularly the ones that have running away depositors as well as flailing commercial or other types of portfolios. So I do think we're going to see more consolidation in that entire banking
Yeah,
sector.
I hadn't thought about that. People are probably going to be withdrawing money because there's going to be more opportunities and get a higher return.
Absolutely, and they should be.
Yeah,
that's actually the case. That you're trying to, as with an institution, as with a bank, people do need to consider how to reduce their financing costs and increase their upside, and that's one way to do it. That's going to impact potentially the most some of the regional banks, and therefore they can absolutely get taken over by the larger banks.
The banking system is pretty solid though so far, correct?
It's got wobbles that have happened. I mean, the four largest banks in the country, including Wells Fargo, JP Morgan, Citi, and Bank of America, have had issues with what they call their own report cards. The stress tests that they have to put their own books under in order to give these reports to the Fed. And so they are starting to see some potential pitfalls along the way, and not necessarily having enough reserves to make up for loan portfolios deteriorating to a certain extent, or if we have some acute economic or labor shortage or whatever it might be, or labor turning downward or whatever it might be. So yes, they are capitalized, they're stable, particularly the bigger ones that are more hedged against, for example, acute commercial mortgage back or commercial mortgage type portfolios, but they're not 100% out of potential critical problems.
They can see it, but they're not out of the woods yet.
Right.
CMBS you mentioned there. That's something that we're seeing a pretty good amount of defaults. Can you kind of go through what's going on in that with CMBS right now?
Yeah, so there's a few reasons. If we just look at CMBS or commercial real estate just loosely as offices, office buildings, as well as multifamily homes, so effectively commercial homes for more than one family, what's happened is, and this has been largely the combination of COVID, post-COVID, and interest rates rising, or the expense of payments rising, is that offices are just seeing greater vacancies. And if you use your office building as the collateral for your office loan and you have more vacancies, your collateral actually isn't worth as much. You're not getting as much money coming in to pay you rent. And also at the same time, the leases for a lot of office buildings or commercial real estate properties are coming due. So in the next few years, and they've already started to come due, leases that were negotiated when rates were lower and just into COVID than they are now. If you also look at the fact that vacancies are increasing, companies aren't renewing their leases.
Yeah.
So that actually creates a deterioration in the collateral of the building as well. If people aren't in the office spaces or the commercial spaces, and if the leases aren't going to be renewed to try and give it time to have people come in, or they might not come in anyway, then all the money that was anticipated to go into the loan or go into the property just isn't there. Right. And there isn't really, I mean, there are some companies that are trying to get their people to come back in, or they're trying to figure out more innovative ways to share office spaces, or to share commercial buildings, or to share commercial properties, or repurpose them on different hours for different things. And so there will be properties that will remain viable and figure out ways to monetize their loans, but there will be others that will just fall short of that. And that's why we're seeing defaults and delinquencies rise in that, and I think, again, that's something that we'll continue to see, because it will take a while before these lower rates move themselves into refinancings, and either way, you've got leases that aren't being renewed.
Right. Yeah, you're seeing in some spots here in Los Angeles that you'll have a new building that is 90+% full, and right across the street you've got a Class B and C, and it's pretty much empty. And so those Class A buildings are getting filled up right now. Those B and C, they're going to have to find a way to repurpose them, and that can be a struggle.
No, that's exactly right, because if companies or individual offices can see that they'll get a better deal, more modern amenities, everything else from that Class A property, then why stay in the Class B one, or why own both if that's what you have? And that's where these leases in the older properties that have been longer and that were cheaper at one point and have being negotiated much higher. And therefore, whoever was in them can't afford them either. Mm-hmm. Whereas in a new property or a more modern property, you know what you're getting. You know what you're negotiating now. It's not like a long-term lease that now is prohibitively expensive to maintain. So there's a lot of reasons for that shift.
Are the CMBS that are defaulting right now, is it mostly office, or is there some multifamily?
There's multifamily in that as well.
Yeah.
And again, that goes back to the household. That goes back to the consumer. That goes back to whether landlords can get families in when other families leave. I think that part of the market is going to require reduced rents from the standpoint of landlords, and then you have to look at how many properties does that landlord or that landlord company own, and are they willing to come down in rent prices. What we've seen so far is that rental prices have continued to basically increase, even though the Fed had raised rates until recently and had said that was going to reduce housing prices and rents. Well, that didn't happen.
Right. I was reading an interesting article for here in LA that where people have been in these properties for years and they're not paying any rent, and they're requesting a jury trial, and the number of that, I had no idea it was as large as it was, but said if those people were not in those units, we'd be in a lot better place, and because now they take care of some of the housing stuff.
Sure.
But there's a lot of ifs right now with this stuff. Yeah.
No, there is, and a lot of pattern changes, and a lot of just running out of money, and not having had the opportunity or the lower cost of money to access to be able to do something about that part of the equation.
Yeah, I was reading that in New York, Dallas-Fort Worth, Austin, I think New York and Dallas-Fort Worth had 30,000 units coming on the market. Austin had 10,000 plus coming on the market. I think it was more than that, actually. And I think Phoenix, a lot of inventory coming on the market. So I'll be interested to see how that plays out. Now, you had said that, come out and said that China is in a balance sheet recession. Can you explain that? And how do you think it may impact overall with commercial real estate in the U.S.?
Well, so when I say balance sheet recession, what that means is, on the one hand, China is still pumping money, and it just lowered rates itself by 50 basis points, which is significant for the People's Bank of China to do in one chunk, and issued a statement as part of their strategy to get their housing market and their equity market back, or at least to prop those up, that people wouldn't have to have as much collateral against new loans in the housing market, and also wouldn't have to have as much collateral for loans to invest in their stock market, which had the impact immediately in the stock market of pumping up the Chinese stock market and the stock market in Hong Kong by extension, because people and companies and investors in that ecosystem decided, all right, well, I'm kind of getting a deal on buying stock right now because of what the current strategies of China to sort of help its own balance sheet, because it's not getting as much income coming in. So it's trying this other way. It's trying to do it by equity shares, and trying to long-term help the housing market. So that's what I mean. There's a mismatch between the actual growth in China and what they're now repurposing people and investors to do by giving them incentives to have less collateral on the side in order to go buy properties which have been stagnant, or to go buy stock. And again, that has helped what they have done. So how does that impact the United States? Well, it means that the Chinese investor or investors in the Chinese economy might be more likely to keep their investment there than they might have been to invest in the United States. One of the interesting things we've seen is that the Central Bank of China, for example, used to own $1.3 trillion worth of U.S. Treasury bonds, of U.S. Treasury debt. They're one of our biggest holders of U.S. Treasury debt. In 2014 through 2018, they owned $1.3 trillion. From 2018 till today, they've basically cut that position in half. That is wild.
Yeah.
Our debt has increased from $5 trillion in 2014 to $35 trillion. Now, our debt size has gone up by 7 times in the years in which the Chinese central bank, as it happens, cut its portion of the debt that it basically funds us in half. They bought gold with some of that cut, but they are definitely all of these pieces, all these factors show us that the appetite for investing in the U.S., even in the U.S. stock market, which of course has also hit records throughout this whole period, might be less from foreign investors than we have seen.
You don't think it's going to cause them to sell here and go back, take their money back to China? Or do you?
Well, I mean that's part of it. I mean, I'm retracting from the equity market, and it's to an extent imperceptible, but happening where they can take money quickly. It's difficult. It's more difficult to sell a piece of real estate than to sell a stock.
Right.
And so one of the things you would first see is them coming out of the stock market and sort of repurposing that money. And because there's so many other factors in our stock market, including U.S. fund managers and so forth, it's a little bit less perceptible. Something like cutting your treasury position in half and continuing to probably do that's just more perceptible. But yes, they can take their money out of the U.S. in different ways. Out of the stock market, that's quick. Out of the property market, we are seeing less buying, and we have for a number of years while this has been going on, of that particular, that segment, the Chinese buyer, which was significant, particularly in luxury and some commercial real estate, that's really dried up.
Okay. What do you think the overall picture for commercial real estate from now going into 2025? What are your thoughts on that? I'm going to hold my seat here because I'm nervous.
No, I mean, I wish, I know commercial real estate is an important part of our general mortgage and housing and stock here, but the reality is I think we're going to continue to see problems in the commercial real estate market with those holders of properties that are not seeing new leases come in and that aren't figuring out a way to refinance at a level that can sustain that lack of income coming in. And meanwhile, having properties that because of that are going to devalue, that they haven't even devalued yet. There's a lot of commercial real estate that's sitting on books on regional banks across the country that hasn't been revalued to reflect these leases that might not be and probably won't be, or at least I would say a third of them. When I say I would say, I've looked at the sort of forecasts on these, about 25% to a third of them over the next 5 years aren't going to be renewed. So that's a significant loss of income. So what else happens in commercial real estate? There has to be shifts. So you pointed out one shift where, that the owners of properties that already have or might be looking towards repurposing their debt or repurposing their financing into newer buildings. I think that is a trend. And I think that will continue. So the action in that respect is not to figure out a way to make the lease look better in the older building, but to figure out how to make it more attractive for the newer building. And so I think from the standpoint of office space, and you're going to see more sharing, you're going to see more consortiums of companies getting into either purchasing or leasing space in those newer buildings. So I think that shift, and that's going to be in cities around the country. So that's going to be one shift that I think is and will continue to happen. But you're also going to have more bankruptcies, defaults, and delinquencies coming into owners that are too stretched, where they're just not getting getting those people or those companies into their buildings. And then I think from a multifamily standpoint, that part of real estate, I really think it's incumbent upon landlords to figure out how to either reduce part of their portfolio so that they increase the incentives or the ability to give offers or better rental offers to families to come in, because it's better to have someone in paying rent than potentially not having someone in a unit paying rent.
Yeah.
I mean, there's tax implications, there's other things to
Sure.
consider, but all things considered, if you're fully occupied and everybody's paying rent, it's generally better if you want income than not being fully occupied and not having people paying rent.
Yeah.
So I think what we're going to have to see is just a turn towards a more intelligent way, maybe, or a more economically viable way of managing properties. But I think that's going to take a minute too. I've seen in a lot of small businesses, a lot of units in LA and just towns outside of LA and cities around the country, towns outside, that these mom and pop shops, these one-off properties that have been in the family for generations, you're seeing people close and leave because they cannot afford new rent. Not current rent, but what happens is landlords are increasing rents at a time when expenses are being squeezed upon these businesses because of consumer debt and other things. And so I wonder why landlords don't necessarily understand this. Part of it's because they can write down, there's tax incentives to taking losses. But it depends on the mentality of that landlord, long-term gain, short-term loss. I mean, it depends on whether that mentality changes. But there's some really good businesses in LA, around the country, that have to close after so many years, just because not they can't make their old rent, but they can't make that new rent. And there has got to be a closure of that. I don't know what makes that happen, if it's landlord specific at a time or corporate landlord specific at a time. But I think that will really help the landlord, the people, and the economy if that starts to happen, and commercial real estate.
Yeah, I think, there's with some of the retail clients that we've talked to, some of the property owners, and they can't go any lower. It's in their loan doc, their loan could be called. So they're sitting there between a rock and a hard spot. So I think, we always suggest to them, have a conversation with your bank.
Yes.
You've got to work this out.
Yes.
And for everybody. And I think if everybody gets to where we're all trying to figure out how to move, it's a negotiation, right?
It is, yeah.
We tell our newer agents, if you really want to win in real estate,
Yeah.
there needs to be, the deal needs to be good for everybody.
That's right.
If it's one side, the other person's losing, make it good for everybody.
Right.
And so I do agree, because our retail agents are doing some cold calling. And this week we had an agent that was a little disheartened because he talked to two people in one day. They said, "Listen, I'm struggling. It's I can't do this much longer."
Yeah.
So that kind of hits.
But I think you're right that people need to all sides of the equation need to want to come to a solution.
Yeah.
That's the first step.
Yeah.
And then renegotiate with the bank. If everyone wants to come to a solution, that's.
Yeah.
Some solution can be better than no solution.
I agree. Now the banks keep kind of kicking the can down the road on some of these, right? These loans are coming due, they're extending, and you're hearing that on a good number of problems. How long do you think that's going to continue, or when is the bank going to be like, okay, that's enough, we can't do this anymore? Do you think that's 2025, 2026, 2030?
Well, I think that this comes down to one of the reasons, the quiet reasons behind the Fed's cut and the acceleration of their cut. Externally, we mentioned labor. They can say things externally like that and point to them, but also there is a banking system problem with loan portfolios. And I think that banks, they kick the can down the road anyway. They get access to cheaper funds than people or offices, consortiums anyway. But I think there's going to be a lot of repricings going on, refinancings going on, and I think that could go through this current cycle of the Fed. The Fed said maybe we'll get down to 3.75, 4 on rates. I think it gets down more closer to 3 in the next year and a half or so, because I think it has to, and I think the Fed knows it has to, because everything we've been talking about today isn't really going to shift.
Right.
It can be dealt with on the basis of refinancing and renegotiations and extending loan terms and all of that. And yes, the banks will continue to do that. But I do think when a lot of these leases come due, a lot of them are 2026, 27, I think that's when we start to see either a significant drop or increase in the Fed helping the bigger banks, significantly more mergers, and something having to give. But I think I think we kind of unfortunately see a bit of this pain, also have a bit of this refinancing in the back, have some extensions going on, hopefully solutions and renegotiations along the way. But that we're waiting, until those dates kind of come upon us, I think we're dealing with extending that problem.
Yeah. What are some of the best indexes there to track or watch and forecast trends in commercial real estate? This one was a question that was sent in to me.
Yeah, it's a great question, and it's obviously we need to be looking at not so much indices, but the delinquency and default data that is coming out of banks, and also one of the actual it's not so much an index. Obviously, there's a Case-Shiller index where we're looking at housing prices and keeping track of in general what the relationship is between residential and commercial real estate. But from a loan perspective, there's no this is how many loans are going to default by this particular bank index. There are bank indices out there, which just gives you an idea of how their stock is doing, not necessarily how good their loans are, and that's not really a way to get the whole picture. There is a website I look towards called bankregdata.com, and
Sounds like a real fun one to read.
It's really fun, but it's there's a lot of charts, a lot of data, a lot of information put together by a person / his company that actually gets all the balance sheet information from all of the banks and turns all of these numbers for us. Okay. And because I am such a geek, I go back to the data. So that's where I go, as opposed to just looking at general indices or where bank stocks are trading.
That's where did you get so interested in economics? Is your family in it, or is this something you?
I don't know. Yeah, I started out with a math degree. My dad was in computer programming and computer science in the beginnings of AI back in the day. So a lot of data, a lot of analysis, a lot of numbers was part of my growing up. So. Yeah,
because you light up when we talk data. You just light up, and I'm like, okay.
That's just really weird. But no, I like the story that numbers tell. And when we look at economics, that's how people and companies are related to the numbers, and so it's all kind of one narrative to me.
Yeah, well, it's been very interesting. What dangers or areas do you watch that may impact the economy the most in 2025?
Well, again, I do think we do need to look at these loan portfolios. I think the labor market, I mean, a lot of the stuff that we have been talking about. I also think how the dollar does relative to other currencies, because if we do see rates getting cut or accelerations in rate cuts, it hasn't really impacted the dollar that much. I mean, the dollar has fallen relative to other currencies a little bit over the past 5 months in anticipation of these cuts and post these cuts, but it hasn't really given way. And so what I look towards is how much of not just the purchasing power of the dollar here, but also how it is relative to other countries, and whether we see a significant weakening in the dollar, which we could in 2025 after our elections, after a bunch of all the other countries that are the BRICS plus countries and other countries that are looking at anyway diversifying from the dollar, that are selling our debt, that are buying more of our debt. You know, all of these little things can potentially make items that we pay for in the United States more expensive, or supply more expensive, or the cost of goods more expensive relative to the value of our dollar. So I think that's one of the things that I'm really watching for in 2025.
Are you a real estate investor?
I own a couple of properties myself.
Yeah. Where would you be looking right now? If you're out investing, what asset class would you be looking at?
That's a really interesting question, because it probably wouldn't be commercial real estate, but that's mostly because it's just beyond my purview.
Yeah.
I tend to invest in commodities, really.
Okay.
Which
is way beyond mine.
and especially now for like a whole other topic.
Yeah.
But I think not even in the United States. I mean, honestly, I'm talking my own sort of dollar weakening and other currencies being stronger. I mean, right now, if one were to use any sort of extra money, I would be looking for what is going on outside of the country as well from a residential perspective.
You know, that's the thing with real estate. We tend not to. We always look so local. And reading your information, I'm like, you know what, I need to become a little bit more aware of what's going on in these other countries, especially China, because there's a lot of money here. And so I think this information was absolutely amazing today. Thank you. What's next for you?
Well, I am, speaking of commodities a little bit, I'm heading off to the UK
Okay.
to have some meetings on energy policy and how the supply chain impacts that, how US impacts that. And then I'm off to the G20 in November in
Okay.
Rio in Brazil to see what's going on in the global stage.
Very interesting. How do we get in touch with you?
So the best thing to do, because I tend to write all of these thoughts and where I'm at, and also investment trends that I see and very specific actions within those on my Substack right now, which is prinsights.substack.com.
Okay.
And so that will be my thoughts on the Fed, my thoughts on commodities, my thoughts on the banking system, and I have a great team of people that work with me on that. So we put out some good stuff. So that's really the best place to look for what I'm doing now.
Definitely going to be tuning in for sure. I'll check that out. Thank you very much. And thank you for taking the time to come in today. This has been very insightful.
Well, thank you so much. It's fantastic to come in and talk to you.
Yeah, thank you. And for those of you watching, if you could please give us a like. And if you haven't done so, make sure you subscribe.